Okay, let's unpack this. Today, we're embarking on a deep dive into some truly pivotal material straight from the European Central Bank.
Hmm.
You sent us this comprehensive report, a report on monetary policy tools, strategy, and communication.
That's the one.
And it directly fed into their ECB Monetary Policy Strategy Assessment 2025. It's an absolute gold mine, really. Gives an amazing look into how the ECB handles this constantly shifting economic scene.
Yeah, and what's really critical here, I think, is that this report wasn't just, some academic paper.
Right.
It was the actual bedrock for the Governing Council's latest strategy talks. So our mission today is basically to boil down the essence of the ECB's strategy, look at its toolkit, which is quite varied, and shed some light on how they communicate decisions.
Kind of like a shortcut for understanding central banking.
Exactly. A shortcut to understanding this complex world from, the pandemic easing right through to that inflation surge afterwards. You'll get not just what they did, but why it mattered and maybe some surprising things that came out of it.
Okay, so let's set the scene. Because context is, like, everything here. The last big ECB strategy review, 2020-21, that was during a time of really low inflation. Felt like a different era.
Completely different world back then.
But then, boom, we all remember the post-pandemic inflation spike. This report really tracks the ECB's journey through that whole whirlwind, from super accommodative policy, then that aggressive tightening, and now, more recently, easing again. It's like watching a masterclass in central bank reaction.
It really is. The period since July 2021, it's just been a remarkable policy shift. First, they were highly accommodative, using tools like asset purchases, APP, and the pandemic one, PEP,
Right, APP and PEP.
and also the targeted loans, TLTROs, and even negative interest rates. But then, second half of 2022, inflation just took off.
Yeah.
So the Governing Council pivoted hard. They started hiking rates in big steps. Remember that 50 basis point hike in July 2022?
Came as a bit of a surprise then.
It did. Then two big 75 basis point hikes later that year. So a total of 200 basis points just by the end of 2022. That was a huge pivot, moving away from promises to this meeting by meeting flexibility.
And what's really fascinating, digging into the report, is how fast the market's expectations flipped.
Oh, incredibly fast.
Like initially, the surveys, the SMA,
Yeah.
right? They thought rate liftoff, so rates getting above zero, wouldn't happen until maybe December 2023.
Yeah, and staying below zero until late 2024 even.
But by July 2022, that whole timeline just got yanked forward massively.
Mm-hmm.
And then the promise to stop reinvesting APP proceeds in July 23 and PPP by end of 24. That sent a strong signal, too.
Absolutely. It just highlights how crucial forward guidance is and how central banks, manage those expectations.
Or try to.
Or try to, yes. And the report makes this interesting point. Maybe the initial delay in starting the hikes was sort of compensated for by how forceful they were later on.
Making up for lost time, perhaps.
Arguably, yeah. Then in 2023, rates went firmly into restrictive territory. The message was, we'll keep them there as long as necessary to get inflation back to 2%.
That as long as necessary phrase became key.
It did. And then, because disinflation was actually happening faster than expected, they started cutting in June 2024. Just 25 basis points to start.
And kept going.
Kept going. September, October, December 2024, and then again into 2025, January, March, April, June. It shows this dynamic, data-dependent approach in action.
Okay, so we've seen how they reacted. Let's peel back the layers now and look at the tools they used. Rates get the headlines, but the ECB has this whole arsenal.
A big toolkit.
Let's start with one that got a lot of attention. Negative interest rate policy, NIRP. The big question from the report. Did it actually work? And were there weird side effects?
Well, the report gives a pretty clear answer. Yes, NIRP did remain effective. It stimulated the economy, and it worked well alongside the balance sheet stuff, like QE.
Okay.
And here's the bit that might surprise some people, despite all the worries about banks.
Yeah, that it would crush their profits.
Exactly. The report found that banks with more exposure to negative rates, the ones holding lots of excess cash, they actually expanded credit more.
Really? How?
They adapted, they managed their margins, maybe through new fees on deposits or making gains on bonds they held. So at the big picture level, NIRP worked. More lending, and bank profits were generally stable. It showed its value in that low inflation world.
That's a key takeaway, how banks adapted. Okay, now the big one. Asset purchases, QE, APP, and PEPP. What did the report say about their impact, especially in crises?
Well, QE, both APP and PEPP, was incredibly powerful, no doubt about it. Eased financial conditions right across the euro area. The estimate suggests the combined effect knocked down the 10-year sovereign term premium.
That extra yield for holding long bond.
Right, knocked it down by almost 175 basis points at the peak. That's huge. But the real insight, I think, wasn't just the size, but PPP flexibility.
Pandemic program.
Yes. It wasn't just about pumping money in. Its design let the ECB target specific problems, like those sudden moments when investors were fleeing certain bonds during the pandemic.
So it was more targeted than APP.
Much more. It had a bigger bang for its buck, you could say, per euro spent, especially in calming stressed markets. That adaptability is the big lesson, though they stress that specific pandemic justification for that level of flexibility won't be there next time.
Got it. So PPP's flexibility was a game changer. Now, alongside QE, they had the TLTROs, the targeted loans to banks. How did they fit in, and what happened when they tweaked them?
TLTROs were crucial, especially during the pandemic. They really brought down funding costs for banks, helped keep credit flowing smoothly, made sure policy got through to businesses and households.
But there was a cost.
Well, the very attractive terms meant it was a significant subsidy from the Eurosystem. So the report details this key recalibration in October 2022. They changed the rules, basically indexing the borrowing rate to the average ECB policy rates.
Ah, so making it less cheap for banks holding onto them.
Exactly. It pushed up funding costs for those banks, which led to them tightening credit standards a bit, maybe lending slightly less, which, fit perfectly with the overall shift towards tighter policy. A neat balancing act.
Okay, now let's flip the coin. From QE to QT. Quantitative tightening. Selling assets back or letting them mature. Was shrinking the balance sheet as impactful as growing it?
The process of shrinking the balance sheet, QT, has been pretty passive, gradual, and predictable. Very different feel from the active QE phase.
Less drama.
Definitely less drama. The evidence so far suggests the overall impact has been broadly symmetric to QE in the euro area, so the reverse effect.
Okay.
The report estimates maybe a third of that big rise in long-term bond yields the 300 basis points from late 2021 to mid-2025 could be down to QT to reducing the bonds on the Eurosystem's books.
But it's more background noise compared to rate hikes.
Yeah, that's fair. Some studies confirm it's less punchy than rate hikes. QT tends to work more subtly on long-term rates through portfolio effects, while rate hikes hit short-term funding costs immediately and send a clearer signal about inflation fighting.
That difference in mechanism is important. Okay, finally, a newer tool, but a really significant one, the TPI, Transmission Protection Instrument.
Yeah.
What's that all about? Why do they need it?
Right, the TPI. Introduced July 2022. It's basically a crucial backstop. It's there to make sure monetary policy gets transmitted smoothly everywhere in the euro area.
To stop spreads widening too much in some countries.
Precisely. To prevent unwarranted fragmentation. The report suggests it was effective just by existing kind of insulating sovereign spreads in some more vulnerable countries when tightening shocks hit. It argues that the smooth transmission we saw during that really forceful hiking cycle probably wouldn't have happened without the TPI acting as a credible deterrent in the background.
Like an insurance policy.
Exactly, but with strict conditions for activation, based on fiscal and macro criteria. And it's important to note it's different from the OMT program.
How so?
OMTs require a country to be in an ESM support program. TPI doesn't need that formal ESM program, making it potentially quicker and more flexible as a backstop, though still highly conditional.
Got it. Okay, managing all these tools, these rapid shifts, communicating it must have been, well, a nightmare.
Hugely challenging.
The report talks about this three-element reaction function they introduced in March 2023. What were those elements? How did they help?
That's a great point. Communication was absolutely key. So the three elements were, first, the inflation outlook, based on all the incoming data. Second, the dynamics of underlying inflation, trying to see the real trend beneath the noise.
Stripping out energy and food, usually.
Right. And third, the strength of monetary policy transmission, checking if their actions were actually working their way through the economy. The whole idea was to provide more clarity on how they'd react when things were so uncertain.
But it was still tricky, especially early on.
Oh, very tricky, especially that period in spring 2022 when some people felt they were behind the curve.
Compared to inflation and other central banks like the Fed.
Exactly. The Fed had started hiking earlier, so the ECB tried to navigate this by stressing things like optionality, gradualism, and flexibility, and importantly, data dependence. But they made a point of saying not data point dependence.
Meaning, look at the big picture, not every single release.
Precisely. A more strategic view, not just reacting to noise.
They also talk about needing especially forceful or persistent policy. What does that mean in practice? How do they decide whether to hit hard or just stay restrictive for longer?
Yeah, that phrase comes from the 2021 strategy review. It raises this important question about how you fight threats to your inflation target. The idea was, especially near the lower bound, you might need to be forceful or persistent.
So how did they apply that during the inflation surge?
Well, initially, you saw the forceful part, big hikes, 350 basis points crammed into just 6 meetings between July 22 and March 23.
That felt pretty forceful.
It was. But then the focus shifted towards persistence. Smaller hikes, just 25 basis points each time between April and September 23, but combined with speeding up QT and really emphasizing how long rates needed to stay high. That time dimension, the how long, became the main tool for a while.
Interesting shift from how much to how long. You mentioned side effects earlier, and the report dives into one people might not think about much, central bank profits. What happened there?
Right, this is fascinating. While the report found side effects on governments, banks, companies were mostly contained.
Right.
Central bank profits themselves took a significant hit, bigger losses than they expected back in 2021. And it was directly linked to hiking rates so fast while there was still tons of excess liquidity sloshing around from QE and TLTROs.
So is that a problem? Does it stop them doing their job?
That's the crucial point the report makes. No, it absolutely doesn't undermine their ability to maintain price stability. The Eurosystem's balance sheet is structurally strong. It generates plenty of income over the long run, mainly from issuing currency seniorage.
Ah, the profit from printing money.
Exactly. And unlike a normal company or bank, a central bank can, in theory, operate even with negative capital. Its power comes from its mandate, its legal status, not its bank balance. That's vital for people to understand.
That is a really important clarification. Okay, beyond all the technical stuff, it really seems like the ECB is putting a lot more effort into connecting with the public. Why is that so important for them?
Well, if you step back, central banks have a lot of independence, right?
Mhm.
But that independence relies on public legitimacy. People need to understand broadly what the central bank is doing and why, and trust that it's working in their interest, aiming for price stability. If that trust isn't there, the bank's job becomes much harder.
And are they succeeding?
The report suggests yes. Net trust in the ECB has been slowly climbing since 2017, and support for the euro itself hit an all-time high recently, 81%. So the efforts seem to be paying off.
So how are they actually doing it? It sounds like it's more than just the usual press conferences.
Oh, much more. They've really modernized things. For the experts, they've worked on making the policy statements, press releases, the economic bulletin clearer, easier to read.
Cutting the jargon.
Trying to, yes.
Yeah.
But for the wider public, they've done new things like our monetary policy statement at a glance. It's a short, visual summary, and crucially, it's in all 24 official EU languages.
That's smart.
And they're using podcasts, their own YouTube channel, Espresso Economics, trying to explain complex stuff with simpler language, relatable examples, trying to meet people where they are.
And the direct engagement. Sounds like they're really getting out there.
They really are. The numbers are quite something. Between 2020 and October 2024, the ECB and all the national central banks together held over 1,400 explaining events.
Wow.
And nearly 80 listening events. They figure they reached about 4.7 million people directly through those. It's not just broadcasting, it's trying to have a dialogue.
And social media, too.
Big time. They've boosted their presence on places like X and LinkedIn, gained over 1 million new followers since 2021. And underpinning all this is a big push on financial literacy across the EU. Lots of the national banks run programs from classes in high schools right down to visiting primary schools. It's a long game.
Investing in future understanding.
Exactly.
So wrapping this up, what does this all mean for you, the listener? You've just had a pretty deep dive into how the ECB approaches monetary policy, its changing toolkit, and this big push for transparency and public understanding. It really hammers home that central banking isn't just about numbers on a screen.
No, definitely not.
It's about navigating huge uncertainty, adapting on the fly, and critically building and keeping public trust.
Absolutely. This report really showcases the ECB's adaptability, facing down deflation risks, then suddenly pivoting to fight a massive inflation surge. We've seen how they use this complex mix of tools, tweak them when needed, and constantly try to improve how they explain it all. And it leaves us with a question, maybe for you to think about. With the global economy still looking pretty unpredictable, what new kinds of flexibility or maybe new backstop tools might central banks need to invent next? And how can you stay ahead of the curve trying to understand these strategies as they keep evolving?